Hello, everyone. Welcome and thank you for being here this afternoon. My name is Tracy George. I'm the events coordinator here at Holistic Plan, and I am pleased to introduce Meaghan Dowd, our director of product insurance here at Holistic Plan. She has four specific destinations, each related to specialized knowledge in different areas of insurance and wealth management. What we're talking about here today is really important, especially as we will be discussing behind the policy, what really matters when it's time to file a claim. Before we dive in, yes, this webinar will be recorded. Yes, the slides will be sent out afterwards, and please direct any questions into the Q&A, and we'll do our best to answer them as we go. Also, within the lobby or the resources tab below, you may access a couple resources already available to you ahead of time, but we will still send out the slides, recording, and then any other resources via email to all registered after the webinar. So no worries, you will get it. This webinar is also eligible for 1 CFPC credit, so you do need to be here live for the full session to get credit. And with that, I'd love to hand it over to you, Meaghan.
Thank you so much, Tracy. So as Tracy mentioned, today we're going to be talking about behind the policy. I've spent 15 years in the P&C industry and learned a lot, especially when it comes to claims. I am the author of Protect Your Lifestyle, Making Empowered, Educated, and Effective Insurance Decisions. It's available on Amazon, really takes a deep dive into kind of all the crazy things that happen when you're talking about personal insurance. And then again, love education and continuing to educate myself on the space and enjoy being around my family when I am not nerding out on insurance. So, as we all know, insurance is really just a word and just some papers until a claim happens. And once a claim occurs, that's where it becomes a contract like it naturally was. And the context matters in these situations. There's definitions, exclusions, conditions, and one small difference can really change the trajectory of that claim. So we've seen this page before if you've attended our homeowners one-on-one. And a lot of times clients, all of us focus on the deck page. So that's that property and liability section. We like to do apples to apples shopping, trying to match those. But in reality, even if we match the deck pages, it's the insurance agreement, the endorsements, the definitions and exclusions, conditions that truly end up mattering when we need our policy the most, which is at time of a claim, whether that's home, auto. Again, the 50 to 80 pages behind those declaration pages truly matter. And again, hard to read out of context, but you can still get good insight into clients' experience or expectations at time of claim with just a general review of those documents. So we actually have some polls today. So our first poll question is going to be, have you or your clients had a bad claims experience? And Tracy, I might have you pull that up for me if you don't mind. Oh, there we go. So I'll give everyone about 30 seconds to quickly answer this. Thank you all so much for participating. Couple more seconds. Wow, looks like a lot of us, over 50%, have had some type of bad claim experience. So we'll end the poll. Let me show you all these results. Hopefully you can see them. So 63% have had or known of a bad claims experience, and about 40% haven't. So thank you again for participating, but really sets the stage on what can happen and how this is something that's pretty prevalent in everyday life. So 1 in 20 homeowners will file a claim each year. On average, that's an $18,000 claim. And again, even if you have a small book of business, maybe you're more a boutique type advisor, that means if you have 60 clients, 3 of them may have around a $20,000 claim. And if it's not covered by insurance, where is it covered? And that's where the basics of claim and policy language really start to matter. So, the first and foremost thing are policy definitions. Again, they're pretty wordy, but when it comes time for claim, these are pretty clear and specific in the how an adjuster reviews and or kind of can determine if coverage is available. So, the named insured, this is one that in order for an insurance policy to even have any value or even really be a legitimate contract, you have to have an insurable interest. So the named insured has to have an insurable interest in that asset, whether it's your home, a vehicle, jewelry, the list goes on, watercrafts. And then from there, the named insured, again, the definition, is it a spouse, maybe someone 21 years of age in your care? Students have specific definitions, and so on and so forth. And really, this is where they start. So if the claim or the individual that caused the claim falls within this insured definition, they then move to the next part of the policy, which is if the coverage is covered, and if it is a covered peril, they then look at what could potentially stop this claim before we start to write checks or put too much resources into it. And one of those is exclusions. That really defines, what is not covered in a policy. Very rarely is it listed nicely on the declaration page. A lot of times it's in fine print, or it's in their what I call like insurance code, where it's just a bunch of letters and numbers, and unless you again go and find that form within the 90 pages behind the policy, it's not always easy to find. But these exclusions vary by company and even by state, so it's important to again understand the basics of them. And then there's conditions. This is something that a lot of people don't think or hear about in insurance until it's claim time. And these are, again, rules that clients have to follow in order for a claim to be covered. One of those is maintaining the heat in a home. So if clients don't maintain the heat, and maybe their gas gets shut off, or maybe they are leaving their second home vacant for a few months because they're not going to be there, but they leave the water on and they don't maintain the heat and a pipe burst, there's not going to be coverage because that condition was not met. Another one is after a loss, your clients have to be pretty prudent in trying to mitigate any future damage. And if they don't take the steps to mitigate future damage, sometimes that additional damage is not covered due to, again, the conditions and expectations of the contract with that insurance company. And the bottom line is, before you file a claim, clients really need to understand just quickly if there's any exclusions or conditions that might have been met that are going to void the claim. If there's gray area, obviously that's when you'll engage the insurance company. But if it's pretty clear based on, again, it's an excluded flood loss, or it's, again, the heat not turned on, that's a pretty good indicator that moving forward through the insurance company with the claim is not going to be in their best interest. Which also comes to the next part, which is what to consider before filing a claim. And one of those is, should they potentially pay out of pocket before they go to the insurance company? If the claim is small, it does make sense. And a lot of times filing a claim can trigger a increase in your rate. So when clients file small claims, maybe it's that $2,500, $3,500 claim, they're going to see a rate increase over a 3 to 5 year period, sometimes even more depending on the loss, that is going to affect their premium. And so again, $3,500 from the insurance company, great, but now their rate went up $600 for the next 3 years, 5 years. That basically is at a break even for what they got from the insurance company. And gosh forbid they have another claim that's like larger, they may end up even paying more to the insurance company than they even got through that claim. So that's why really determining if paying out of pocket before rushing to the insurance company to get checks is important, especially, again, as an advisor, clients' liquidity, where they can comfortably write checks and where they can't. And this is a great place to kind of help save them from future disruption based on choices they could have, made better decisions on. It also affects marketability. So claims history, it doesn't always follow you, when you move homes, but it does follow the location. And so sometimes it can make it harder to sell, just because, hey, if they've had a water backup before, what's to say they're not going to have one again? Sometimes there's insurability clauses when you go to buy a home or sell a home. And again, if there's one or two water losses, or even just two claims that have to do with, a pipe or the electricity, those can make a home uninsurable, which then makes them really hard to sell in the marketplace. So again, as an advisor, more about your client. If it's in their plans potentially to sell the home in the next 3 to 5 years. And if so, maybe making a few different decisions on where and when we're filing claims, just to make sure that we keep that home as sellable as possible. And then again, where advisors can really weigh in is, you understand that maybe they filed a claim, 2 years ago, and they recently moved to a new insurance company, and they don't know that. And two claims in 3 years could be really bad for my client from insurability and pricing. Again, their liquidity, and you can help them just make better choices in terms of paying out of pocket, or again, transferring that risk to the insurance company to write the checks. So there's hidden costs that come with the claim. First is, like I mentioned, those higher premiums. So insurance companies not just giving your clients free money, they have a surcharge after most claims are filed for 3 to 5 years. If your client has a water loss, not only are they going to see a surcharge, but one of the trends in the market is they now require water mitigation devices. So that might be a water shutoff valve, that might be a water leak detection system. One, it helps deter future losses, but insurance companies and the actuarials have the numbers to prove that, like, once there's a water loss, there's most likely going to be additional ones. And so requiring those mitigation devices before they even take on new business is how they're trying to, again, deter too many claims and hopefully keep pricing competitive in the marketplace. But again, that's another piece that not only is your client going to pay the deductible at a water claim, sometimes they may have requirements to put in additional protection to stop future losses. And then things like auto violations, those can sometimes affect your auto records for 10 years. So that's something like a DWI. Um, Otherwise, any moving violation typically is about a 3 to 5 year look back period. And then we have a claims frequency issue. So this is when clients are like, oh, well, I have full glass for my windshield. I'm just going to file a claim every time I have a chip in my window. And while, yes, you might not see higher premiums because of that, because it's not a chargeable claim, you are going to see issues with frequency. So you might actually lose that type of coverage where the insurance company says at renewal, you no longer get full glass coverage. And or see this a lot with towing. Clients that have older cars love to use the towing on auto insurance, and that ends up really hurting them in the long run from a frequency issue. And in those situations, something like a AAA membership card or a towing only type subscription works really well and benefits them substantially in the long run when it comes to claims frequency. And then again, it, like I mentioned, leads to non-renewals and coverage restrictions. And then it also affects shopping. So, the TV has made clients believe that they can go call anyone, go to any storefront and get insurance quotes, and that they may even be able to save 15% when they do it. The reality is, if there's a claim on their record, not only are they going to see pricing increase, but they may not be able to leave the company they're currently with. And sometimes after that claims experience, they may be so frustrated that they no longer want to give that insurance company their money, but they filed too many, again, auto claims, or maybe this is their second home claim. Whatever the case is, the claims record does affect how a client can shop and kind of what the rates look like when they go to do so. So, how do companies track claims? And there's two systems that they use. One of them is a clue report. So, the clue report is what tracks property damage on home and auto. So, this is going to be things like if you're an auto collision, or again, if you have a house fire, if you have a dog bite at your home, anything that happens at your property, or again, that is moving, is typically on the clue report. The auto has a second report called an MVR, which tracks your violations. And what's important with the MVR is sometimes it'll show items that don't have points. And typically, in order for it to impact your rate, there has to be points associated with it. So that's like speeding tickets and items of that sort. You've probably heard me say a few times now in this presentation, chargeable versus non-chargeable claims. So what I mean by that is chargeable gets a surcharge, which is on the base premium for the year. So not only are your clients going to see their rates just go up year after year due to natural rate increase, they're going to see an additional surcharge on top of that for those claims. Again, that's things like water damage, auto collision. And then we have our non-chargeable claims, which are things like hail damage. And while your clients may not see a surcharge or, again, that additional charge to premium, they do lose or see premium impacts another way. Sometimes that's in their pricing tier. So insurance companies all have different tiering mechanisms that affect your rate, and they also lose discounts. So a big one that clients tend to lose is a claims-free discount. And again, they don't think about it till after the claim. And especially when it comes to hail, roofers love to come to your door and tell you, oh, file a hail claim. It's a non-chargeable claim, but you actually have, again, a really nice discount for that claims free. And maybe the hail damage wasn't that significant, and it turned out to end up costing you more each year on the homeowner. So again, that's really how, when you go to shop or move insurance companies, they can kind of track what's happened to the home, the auto, and kind of the overall makeup of your household from a claims perspective. So the other thing when it comes to claims, and we see this a lot at Holistaplan when we do our reviews on policies, is clients have great bells and whistles. They have things like accident forgiveness, diminishing deductibles, single deductible, which means if they have let's say a fire at their home and their car's in the garage and both the home and auto are damaged, they only have to pay their home deductible. Or this claims free cash back, which is one we see on lots of commercials. And in all reality, these are great to have. They're really like a nice aha moment at time of a claim, but they cost your clients money. And really, as an advisor, what you should be talking to your clients about is, one, is it worth the additional premium? Two, are we missing more important coverages by focusing on bells and whistles? A lot of times I'll see these bells and whistles on auto policies, but then the liability is 50,000 per person, 100,000 per accident, and the client's worth, at risk value is 800,000. And so they're really low on the liability limits, but they have these fun bells and whistles. And that's where, again, at time of claim, they probably would have rather known that they could have increased their liability for the same amount that they're spending on the bells and whistles and had that financial protection that truly matters, because a check is nice, but it's $30, $40 every 6 months and just not as impactful as the right auto liability. And then again, your client's risk tolerance, not only in the marketplace, but obviously if they're, risky in the market, they probably have a higher risk tolerance and might be willing to absorb more losses for themselves personally, write the checks. They have the friends that can fix the home, whatever it may be. You do have an insight into that life that insurance professionals just don't have. So again, you can help them decide if these additional bells and whistles really make an impact on their overall needs, or if they could be better adjusted elsewhere. And again, frills fade fast in a crisis, and it's really helping clients look at the core protection for their assets. So, lastly, when your clients file a claim, sometimes when they buy their insurance, they buy it from an insurance broker, they buy it from the State Farm individual. But then at time of a claim, they talk to a whole new set of people. Sometimes, well, all of them are known as adjusters. Sometimes it can be a single adjuster. Other times there can be multiple adjusters involved, especially when it comes to auto claims. Sometimes you'll have a property adjuster that's dealing with like the damage to the vehicles. You then have a bodily injury adjuster that's dealing with like injuries, and they have a few different people in specialized areas of coverages, and your clients end up managing a lot of that if they're not with the right insurance partner. So to take a step back, when we talk about adjusters, this is who your clients end up working with at time of a loss. And so the ideal situation is that they're working with a carrier adjuster. And in all reality, this isn't the typical. A lot of your big brands do have the internal carrier adjusters, but there are a lot of people that use third party, and we'll talk about those next. But carrier adjusters, again, are employees of the insurance company. They don't obviously cost your clients anything to work with at time of a claim. They do the inspections and estimates, but they really know the company culture. So Travelers is one that comes to mind. They have a lot of in-house adjusters, and so they know, again, the culture of the company, how they want their clients to feel, the intent of how the policy was written, and in my opinion, tend to adjust claims just differently than we see with an independent adjuster. And these are contractors hired by third parties. Again, the loyalty still tends to be with the insurance company. There's no cost to your client. We see this a lot of times, again, with just different types of insurance companies, or example with Travelers, if there is a catastrophic loss, maybe they'll have some independent adjusters come in just to help keep the process moving. And so again, that high volume. But this is where a lot of times these individuals don't always know the policy as well as an in-house carrier, because as a independent adjuster, they could be working for State Farm, Safeco, Travelers, Cincinnati, a whole different, bunch of different insurance companies, which makes it really hard to truly understand the fine print and where coverage may be given or taken. Whereas again, that carrier adjuster, especially if they've been with a company for a long time, know the nuances, the gray areas, and really how to adjust properly. And this is something your clients can ask their companies. It is sometimes on Google, but the last type of adjuster, and this is the adjuster nobody really would ever want in claims, and this is necessary when your client and the insurance company don't agree on the overall claim settlement. And unfortunately, these public adjusters do come into play more often than I would like to acknowledge. But this is really someone that the, again, policyholder, your client's going to hire. There is a fee, and they're really going to review the damages, help dispute, negotiate. But they don't work for the insurance company. They can't write the final checks. They're really there more to work on behalf of your client to help fight against whatever the decision was that the carrier made or that independent adjuster made. So when you hear adjuster, technically there's a few different types of adjusters that fall into that category based on the insurance company and potentially the type of loss that they're experiencing. So real quick, Tracy, do we have any questions before I continue?
Yeah, we have two questions. The first
Okay.
one is there a rule of thumb in dollar amount for when to pay out of pocket?
No, and I think that's really the magic that advisors have. Like I used to work with a very wide range of clients. Some of them couldn't even write a $2,500 check, where some of them could write $50,000 checks like it was a Tuesday night going to dinner. So, like, that's where, as the advisor, those different thresholds and what's really going to disrupt their planning or what's more of, again, a nuisance to planning and not a complete catastrophe to planning. So I wouldn't say there's a dollar amount that I would give at this point, but really more, again, based on what the client's planning goals are, what their savings goals are, and those sorts of things. And then typically insurance, the initial like increase can be anywhere like 15%. So even if you just do quick math, again, I tend to tell clients anything under 5,000, definitely pay out of pocket if you can. I had a call a couple days ago with an individual and they were talking about writing a check for a $25,000 claim out of pocket. So there's a whole nother thing we could talk about on a side review about if you do pay out of pocket, especially when it comes to liability claims. There are some nuances there, but when it comes to property damage at your home, it's pretty safe just to write it out of pocket if you can financially do so.
Great. The next question is, does being in an accident that was not your fault affect your rate?
So usually the not at fault accidents fall into that non-chargeable category, but we can sometimes see that accident free discount go away, and or again the tiering change just based on the makeup of the account. And while again they weren't at fault according to actuarials, they were in the wrong place at the wrong time, and so they might again move down a tier or two based on those new numbers.
That was all the questions right now.
Fabulous.
Mhm.
So, a lot of times with claims, there's disruption and it comes down to expectations and reality. And so clients expect full checks up front. Typically, they expect replacement costs, that the money comes quickly, and that there's minimal legwork on their end, especially because they feel like there's a lot of legwork to even get to the policy being purchased. Unfortunately, what ends up happening is there's delayed payment, and a lot of that's because money comes in stages. So they'll give you the actual cash value up front, and then as you replace personal property items, you start to get that depreciation value as you submit receipts, which takes us into the next point of the documentation required. In order for an insurance company to pay out, there has to be proof of ownership. So again, whether that's a photo with you wearing, the clothes or a piece of jewelry and or the actual receipt, proof of documents is something that really, really slows down claims. That depreciation first, again, clients are always shocked by that, and it is a very frustrating situation, especially at time of larger claims. Insurance companies can hold back, 5, 6 figures and put the clients what they feel like is in a tough position. And then sometimes there's just more involvement needed, again, with scheduling between all the different adjusters they have to work with, or going and digging up old documentation, maybe taking photos of items. It does become burdensome on clients when they experience claims. And again, that's where, as an advisor, hopefully you can help them understand like what their policy covers by doing proactive reviews with them. So if and when these situations occur, hopefully they're not as shocked. And then when it comes to claims, there's two types of claims that can happen. There's typically a total loss or a partial loss. And when it comes to homeowners, When it comes to partial losses, a lot of times that's based on the repair estimate, but where the frustration comes in is at the language in terms of same or similar type quality. And again, for most clients, similar quality is okay. That is the standard, and the industry is similar. However, for your high net worth clients or your very particular clients, that same verbiage may make a huge difference. Maybe they spent a lot of time looking at, different materials and imported rock that they now have on their fireplace or for their kitchen counters. That's where that same language really becomes a huge impact. And then again, the stages of replacement costs and that depreciation and really that full reimbursement after proof of repairs. And sometimes if your clients don't choose the right contractor, that can become a huge issue because the obviously contractor wants all of their money up front, or they expect the client just build the right checks. And if they're not used to submitting documents to the insurance company to get those additional reimbursement checks, again, it can become work on your client to deal with that contractor and the insurance company to make sure they're submitting the right documents so your client can get a check that they then can write over to the contractor. So again, partial losses, hiring the right people to help repair, whether that's the home or the vehicle, can make a big difference as well. And then we have total losses. When it comes to home, one thing that a lot of consumers assume is that there's a cash out option on all policies, and that is just not the case. In some states, there's cash out options based on like the loss that occurs. So in Missouri, if there is a total loss caused by a fire, regardless of the insurance company, you're most likely going to get that cash out option. But a lot of times, this is a bell and whistle that is part of those higher net worth companies, but again, might be something that really matters to your client if they have a total loss. An example here is like maybe you have those clients in retirement, they're still in that family home that they raised their kids in. And if they had a loss tomorrow, they actually wouldn't want to go through a year to 2 year rebuild process on that home. They'd want to take the cash, sell the land, and just go buy a condo elsewhere, move on with life, and not have to deal with the rebuild process. And or maybe you just work with a really busy family. And again, the idea of rebuilding a home or just building a home from the ground up overwhelms them, and they just want to take the money and go buy a home elsewhere. They don't always have that luxury unless they specifically have that cash out option, which really, again, regardless of loss, allows them more flexibility at time of a total loss. The other piece is ordinance and law coverage. So this is a coverage that is given to a lot of clients, not always. So please watch out. We do show this exclusion in our system, but this coverage becomes extremely important when there is a partial loss that turns into a total loss. And what I mean by that is there are some codes baked into municipalities that say if you have a partial loss that is over X percent, we'll just say 70% in this case, we require that you do a complete tear down and rebuild. If your clients don't have appropriate ordinance and law coverage, that additional 30% to knock it down and rebuild is out of their pocket because they don't have ordinance and law coverage. And the only reason that the insurance company is required to do those changes is because of ordinance and law. And that's where these minute details become so impactful because, again, most clients, most municipalities may not have that, but some do. And ordinance and law is very cheap coverage, but it can again completely change the one, just if it's a partial or total loss, but two, the amount of dollars that clients are paying out of pocket. We have the same situation for autos. So at time of a partial loss with vehicles, they're repaired, and a lot of times they're repaired with aftermarket parts. And for again, some clients, this is infuriating. This is unacceptable. They drive high-end cars, or they just take really good care of their standard vehicle, and they want Toyota parts put back in. They don't want aftermarket parts. And in a lot of cases, unless they have OEM parts endorsed onto their policy, they're going to pay the difference between aftermarket parts and OEM parts if they're insistent on the repair shop repairing that way. So again, this is where you probably know your clients have a passion for their cars or just maintaining their vehicles. And you've heard them say, oh, XYZ car is going to the dealership today for the oil change. If they take it to the dealership for the oil change, they're going to want to take it to the dealership for the repairs. And a lot of times dealerships require OEM parts, and or that they work with OEM parts. And again, that's where we see clients sometimes coming out of pocket. And again, State Farm is one of those companies that they're aftermarket parts most of the time, and it's a lot of high-end vehicles with them that clients can end up paying out of pocket, even just for some simple glass versus the technology glass that might be in a BMW. Um, and then we have our total losses. So this again is where if the vehicle's damage exceeds a certain percentage, usually 70 to 80% of the market value. Keyword with auto is market value or actual cash value. Very rarely is auto covered on a replacement cost basis or an agreed value. You can't endorse that onto policies. So again, unless it's clearly stated on your client's policy that they have agreed value for their car, they're probably going to fall into the market value, and again, that percentage basis. And a lot of clients are okay. Again, some clients do get upset when there's a higher total loss percentage, meaning a vehicle can be pretty damaged at 80%. And while yes, you can go and get it repaired, is it really the same vehicle if it's sustained that much damage? But again, based on the policy contract your clients have purchased, the insurance company has the ability to put your client back in that car as long as they can repair it back to their standards. And again, that might mean aftermarket parts. And in some situations, especially again with classic cars or cars that just have an emotional value to clients, they may not want the insurance company to total out that car and take the car and either destroy it or take it to an auction house or whatever insurance companies do with vehicles after a total loss. And in certain situations, you do have the ability to salvage title or buy that vehicle back. And with the right classic car policy, you sometimes can get like the best of both worlds and salvage and, getting some dollars to help repair. So again, total losses, depending on your client from a vehicle standpoint, going with a carrier that totals out at 60, 70% might be better for those super safe clients that again are updating their cars every 3 years and would be like mortified if they had to drive a car that again had a decent amount of damage, more so from a safety concern. Again, we can make the body look great, but is the engine and all that really working well? And then like I've mentioned with the auto, it's an actual cash value. They don't care about maintenance on the car. They don't care that your client just put new tires or just did the 100,000-mile maintenance that cost them a couple grand. If they're in an accident, they're looking at, again, the condition, the mileages, and the actual cash value of that vehicle. So again, claims, hopefully no one ever has one, but there's a lot of confusion and misconceptions that end up costing clients. So again, it's not a chargeable claim. Why did my rates go up? And again, they lost that discount. They had the risk tier change, and insurance individuals are not great about disclosing this to clients. So a lot of times, again, maybe it's that small hail claim to the car and it's a $2,000 check, and they're like, okay, I mean, it's not chargeable. I pay a lot of money to the insurance company. I might as well get $2,000 back. But now they lost that claims free discount. And while it was only a $200 discount, it was still a $200 discount, and they didn't really need to get the hail damage on their car fixed. So this is where, again, just knowing that even a non-chargeable claim can still have a financial impact, I think is a huge misconception. Another one is my premium stayed the same this year, so I'm in the clear. Sometimes if claims happen close to the renewal and they're not closed prior to the renewal going out, the insurance company can't actually adjust rates for that term, but you will see the impact on the following term. So again, whether that's speeding tickets, auto accidents, home claims, you might be in the clear the first year just based on timing of when everything happened and being quote unquote lucky, but it will catch up to you. Your clients will see an impact eventually once again the policy is rated appropriately. The other idea is, well, I can just shop if my rates go up. There's again, the commercials say I can save 15%. Everybody wants me. I'll have options. But once you have a claim, not only do you have less options, you're going to pay higher premiums. And sometimes, again, your current company may be giving you a longevity credit that you're not going to get when you go out to shop. And so, in all reality, even after filing a claim, your current insurance company may be the best option for you. And then lastly, and the one I've said here and we all hear all the time is, well, that's what insurance is for. But it's really meant for catastrophic losses. Again, between rate increases, non-renewals, and trouble shopping, insurance is not what it used to be 20 years ago. And it's mostly a safety net. It is not a subscription to protection. So I'm just going to go through a quick timeline, and this is an auto accident that I handled on a regular basis when I was an insurance broker. So unfortunately, client driving to work, they're in a really bad auto accident. This client had nice golf clubs in the back of their vehicle at the time of the auto accident. So what do? They call the claim in, and when they're calling the claim in, they realize since they had the golf clubs in the car, they actually have two deductibles. They have one for the damage to his vehicle, but they also have a $1,500 deductible for their homeowners. And that's because most auto policies don't cover personal property. There are a few that might give you like $500 or $1,000 in personal property, and I think that is a huge benefit that a lot of individuals overlook because we all leave stuff in our car. Let's just be honest. And so having two deductibles for this type of situation is extremely, extremely frustrating. So off the bat, the client's going to be out of pocket at least $2,500, which again, he was probably expecting 1,000 for his auto deductible, but definitely not expecting that home deductible. And then we have day 2 through 5. And this is kind of where the chaos begins, where clients start to understand the fine print in their policy that no one explained before. They're already overwhelmed with what's going on. Maybe they're still a little shaken up from the car accident, but now they have to start calling shops to figure out who can repair their vehicle, figure out a rental car. Not only, again, the insurance company tends to set up the rental car reservation, but maybe they now need to get to the rental car and they don't have family in the area or whatever the case is. Then they start talking to multiple adjusters. They have, again, a adjuster for the damage to their car, a adjuster for any bodily injuries that were sustained by the other party, and they have a homeowner's adjuster for the property that was damaged in the vehicle. And then we get to start negotiating. So not only are we dealing with all of these moving pieces, now someone is trying to talk with them about the value of their vehicle. And in a lot of cases, clients take really good care of their cars, and negotiations are a slap in the face when they come in at actual cash value. And so, unfortunately, on day 5, they do declare the vehicle a total loss. The client is made an actual cash value offer. They agree. What a lot of clients don't know is once you sign that dotted line and agree to the dollar amount for your car, you kind of set off a time clock for how long you can keep that rental vehicle. So once you sign that, typically you have about a 3-day window to find a car and return the rental car before you're paying for the rental car out of pocket. So my advice here is if clients have any suspicion that their car is going to be a total loss, start looking for a new car day one. If they're going to need a rental to help them get to and from work, just maintain life. Because again, once they say yes to whatever offer they agree upon with that insurance company, they do kind of put themselves in a tight time slot. So again, now day 6 through 8, we're in a time crunch trying to figure out what car do we buy. Again, my car had really low miles on it. It was an older car, but I've maintained it so well. Or it was a brand new car, but I went to the auction and got a great deal. I can't go to the auction in 2 days. Again, just a lot can happen that is overwhelming to clients. And then lastly, now they're dealing with the homeowner's claim and they're having to find a photo of the golf clubs or show proof of ownership. And were all the golf clubs in there? What's the value? And just as you can see, in a very short time, this is going to take up anyone's day, let alone trying to handle life, their work, their family. So, again, this is a claim we see pretty often where there's auto and home pulled into one, and just the complications that start with those. So there's the claims curveball. There's stress, steps, and lovely surprises. And where it really breaks down to is depending on the adjuster your clients are working with. So again, whether it's that in-house adjuster or that third-party adjuster, they don't always get return calls. A lot of times those adjusters are in the field during business hours. And so they're not great at managing phone calls and really those bedside manners, because this is the 10th fire claim they've dealt with this quarter. And guy, just like keep going. Again, too many people involved. They're really slow on updating. They might be moving the process along internally, but they're not always great about updating your clients. And then we love jargon in insurance. So there's a lot of, hey, this is ACV, you again, rental car reimbursement, loss of use coverage. We'll call if you have a loan on your car, then you have gap coverage. And Most folks don't know what any of that means, and it's really hard to learn what all of that means when you're experiencing possibly the worst day or hardest day of your life. And again, what this really means for clients is there's delays in payments. They feel lost and ignored when they don't get calls returned. And I'm sure a lot of you unfortunately get those calls of like, oh my gosh, insurance is so awful. I really need to go buy a new car. Or again, I really need to get this check to my contractor. And you're just their sounding board because they trust you guys, and again, sometimes just need to vent. It needs rework. Again, clients lose trust, and there's just a lot of frustration within the entire process. And a lot of clients aren't expecting, again, that's like, kind, and quality. A lot of them are assuming they're going to get same brand and finishes. And that's not always the case. They don't always get identical replacements if they don't have the right policy. That depreciation first, the caps on coverages. People are always shocked that, oh, well, I have all this jewelry and none of it was over $500, but I had 10 pieces that were $500. Well, hey, ma'am, we're only going to give you $1,500 for all of those pieces. And they're like, gosh, that's a lot. And the biggest one is when it comes to homeowners claims, auto's the same way, but people tend to expect it a little more. The mortgage company will be put on the claims check if it's large enough. I had a client one time who had a really nice roof and their check was about $200,000 to replace their roof. And they had to go, it was a nightmare, but the mortgage company had to sign on it, and then it actually had to go into like the escrow account, and then they had to like go into it, and the mortgage company held it for a while. So like sometimes it's very shocking when your clients have to end up dealing with their mortgage company at time of a home claim when it really has nothing to do with them, but they have a loan on it. So this is another important piece. If your clients pay off their mortgage, have them tell their insurance company ASAP. So if they have a loss, they don't have to deal with the nightmare of either getting a check recut or again having the mortgage company sign it over. There's a whole host of things that end up happening. And then again, auto claims, it's that actual cash value really surprises people. Aftermarket parts, again, saw it all the time when I would get new clients, and that they tend to have a claim. They didn't realize that they didn't have OEM parts. And again, it might have even just been as simple as a windshield. And without OEM parts, they just wanted to put a piece of glass back in, but their windshields, again, have sensors and heaters and coolers, and OEM is what's going to put that type of windshield back in. Again, disputes over mileage and condition, and then reimbursement, no reimbursement, sorry, on maintenance and oil changes. Again, that's not too frequent, but when a client does just put a lot of money into their car and it's stolen, or again, they're in an auto accident quickly after, they do feel that pain a little bit more of, again, they just invested in their vehicle and they don't get any compensation for that. So document demands, they delay everything, and they really become a problem in a home auto claim that clients experience. And this again is a space that I do feel advisors can help clients better prepare for. So at time of a claim, we've mentioned they're going to request receipts, invoices, appraisals. As an advisor, encourage your clients to have digital records as you hear them, oh, we purchased a new refrigerator, or hey, we just put in a whole new bedroom set. Like, just remind them to have digital copies of those. A lot of times there's delays due to paperwork, so providing them a secure place to store these documents via a portal, so when they do have a claim, they can easily access them and get them over to the appropriate team. Again, guide them through what to expect at time of a claim. Clients are often caught off guard, and now that you've attended this webinar, you can hopefully better prepare them and just what to expect in the typical hurdles. So when they do experience them, one, they don't feel like, why is this happening to me? But two, they can just be better prepared and hopefully be a little more sound in the decisions they make in the moment. And then lastly, lost records actually can reduce or deny payouts. So having you all help them have a second set of eyes and a second set of documentation to help them get those payouts and avoid claim denials, I think is a huge value add. That again, at time of a claim, they can quickly call you. You can be the superhero that has the appraisal for the engagement ring that the husband bought 10 years ago that you've had saved into one of the amazing systems you work with. And again, really turn a claim from, oh my gosh, my wife's not going to be able to go get another engagement ring after she's had this one for 15 years to, oh, hey, here's the document. You're going to get the check quickly and your wife will have a ring on her finger by the end of the week. And all that's due to you guys just, again, collecting a few more documents than you already do and saving them in those wonderful systems. So, what makes a strong claims experience? Internal claims philosophy, it really matters. It's the underlying approach to culture. This is where, like I mentioned before, those internal adjusters can really make a difference on how they follow through on this philosophy. It also helps clients understand like the tolerance between the willingness to settle and litigate. A lot of insurance companies have nicknames within the law field based on their frequency in the court. So it is actually surprising how this is actually a very telling statistic that just by going to Google and like most litigated insurance companies, you'll start to see a trend pretty quickly. The emphasis on cost control and loss prevention. Adjusters do have incentives to get claims closed quickly and efficiently. And so, again, sometimes adjusters use that to their advantage and, again, play in the gray area a little differently. And other times they have some controls and very tight restrictions that end up making claims longer than necessary. And then, obviously, customer service and communication is extremely important. And this matters to clients because the claims philosophy determines the speed and ease of doing business at time of a claim, the fairness of evaluations, kind of the approval of denial of those claims, level of transparency, which again, when you're going through a claim, transparency is key, along with communication, in my opinion. And then how aggressively do they manage these claims? Again, if insurance companies don't manage the claims process and they're okay with claims being open for an infinite amount of time, your adjuster has no real push to get back to you in a timely manner. But if it's culture that, hey, we like to close our basic claims within a 24-hour window, and that is definitely a thing out there, those adjusters have more incentive to call your clients right back and make sure those smaller claims are handled effectively so they can meet their KPIs and internal quotas. So again, claims philosophy can really matter when it comes to the strength of an insurance company. And then service model. So again, this is something that even before a claim happens, you can pretty much get a good feeling for their communication style. So within a transactional company, it's going to be limited. The clients typically drive the follow-up. So at renewal, they're going to be calling the insurance company or the broker and saying, hey, why'd my rates go up? Can you shop them for me? The claims handling, there's usually minimal involvement. They give you the 1-800 number and tell you to have a nice day. Again, it's small, straightforward type claims, and people are pretty self-reliant on that experience. Where we see the high touch, again, not only from a day-to-day interaction of, hey, I need to add my car, but when it really matters, they're regularly updating your clients. That's either they're at renewal, on a newsletter, something that's touching base. They advocate for your client's best interest. They help in those complex claims. So before your clients even calling the insurance company in dealing with an adjuster, they're talking to their insurance professional. They're having that conversation on, hey, my 16-year-old just got into a claim. We had this claim last month. Do we really file this one? Or again, we have no claims, but it's a 16-year-old driver. It's only $2,500. Do I really want to get the company involved? That's what a high touch insurance company can do for you, is have those proactive conversations with your clients. One, so obviously you guys can have different conversations, but really help guide the use of their insurance policy. It reduces stress. It makes large and complex things a lot easier. And again, it's really the ideal partner for a financial advisor to protect the client's financial interest. And so a lot of times claim satisfaction correlates with financial strength. And so that satisfaction, again, is just the responsive time, the fairness, the communication, and usually higher claim satisfaction does equal less stress. And then the financial piece is their ability to pay. So if you've been in any of our other webinars, you've heard me talk about admitted and non-admitted markets. And really, again, a admitted market, their financial strength, matters, but they do have a little bit of cushion because they are protected somewhat by the government. There's caps anywhere from like 200, thousand up. But on that non-admitted market, they could potentially have good financial strength, but still become insolvent due to a catastrophe happening. But for those non-admitted, admitted markets, whatever way we're looking at it, financial strength really tells the ability to pay claims. There's a bunch of different resources, so that could be Moody's, AM Best, and again, high financial strength just really gives confidence that they can cover large catastrophic losses. So, what's the advisor's role in all this? While we've hinted to it a few times, it's really helping set client expectations, prepare them the way they often wish they had been prepared. So, encourage them to understand their policies, help them build, clarify deductibles, kind of prepare them for that typical timeline, and guide them to be financially smarter and when to pay out of pocket. You can also be a steady voice throughout the claims process. So, reassuring clients to keep focused on the long term goal. So, again, while writing that $10,000 check today might hurt, long term, it's really what's best and really in the financial plan we're working towards. The clarity, bridging communication, again, between them and their insurance professionals, and then providing that emotional support that you guys do on so many other occasions, but now just leaning that into their PNC claims experience. And really, proactive protection reduces risk and even reduces premium. So for auto, one ways clients can reduce claims is through telematic devices. So most insurance companies offer these today. They do track your driving, but FYI, you're being tracked in a lot of different ways. So I do highly encourage clients to participate in telematics if they're good drivers. So it looks at things like speeding and time of driving, but can give you anywhere from like a 15% discount all the way up to like 30 or 45% per vehicle. Some companies can negatively impact you. So, again, look into that. But then there's obviously driving courses and your vehicle safety. For the home, we have things like fire alarms, burglar alarms, leak detection systems. And this all matters because these aren't just tools about discounts. They reduce claims, they protect wealth, and they really reflect that you guys are helping them manage their risk. And I'm starting to move a little quickly. I didn't realize we're almost at time. So, a few case studies for you guys is this is a client that had water damage, and the difference between an HO3 policy and the HO5 policy and how they pay out based on what losses occur. So, with the HO3 policy, the client had a, excuse me, pipe burst, and in that situation they had no coverage on the HO3, so the client ended up paying out $50,000. And the main reason for that is because of how the damage occurred. So when they were out of town, they had an ice maker leak behind the refrigerator, and it damaged the dwelling, so $30,000 in damage to the hardwoods. They had personal property, their rugs, some speakers, and electronics. And since leakage was not part of that coverage, the client ended up paying $50,000. Whereas with the HO5, the insurance company paid $50,000 plus, and the client actually paid zero. That was because of endorsements the client had. One, they had a waiver deductible for claims over 50,000, and then they also got reimbursement for a risk mitigation device for a water shutoff valve due to the water damage, which is why they actually got a little bit more than just the $50,000. Just a quick highlight of some of the most expensive type of homeowners claims that we tend to see. Then we have our brother-in-law that is driving the vehicle on the holiday. So the issue here is the client is with a budget-friendly insurance company for the first one. And what a lot of people don't know, and it's becoming more standard in the industry, is permissive drivers no longer are guaranteed the limits you have on your policy. We then have a rental property that had a loss and the DP1 versus a DP3 policy. So in this situation, the client ended up paying $1,200 out of pocket because the personal property was not covered, as well as the loss of use had some limitations. But most of the claim was covered with the DP3 based on the policy language. We then have our excess policy. So this is one where a teen driver caused a serious auto accident, and from that auto accident came a lawsuit. And based on that lawsuit, There's technically two types of excess liability. One is truly excess, meaning it's only going to respond if there's underlying coverage in the home or auto policy, where the umbrella liability could sometimes be first dollar if there's not an exclusion within the policy. So this is a situation where excess liability it did not pay for this emotional distress. So one of the passengers after the accident had some emotional issues and had a claim for $200,000. So since this personal injury was excluded on the homeowners, the excess liability is not. The umbrella policy covered the entire claim because the emotional damage or personal injury was not an exclusion within the umbrella policy. So again, just quick difference on how potentially spending a little bit more on broader coverage can make a huge impact at time of a claim. So just wrapping it up, when claims go wrong, it's not just cost. There's time out of work, time away from family and pursuits. Advisors, you can help them by going over coverage gaps, help them with legal or financial exposures, the emotional toll. Again, things we can help avoid. Just help them understand a little bit better before the loss, support them choosing quality coverage, not just the cheapest, and work with advisors who prepare you with the what ifs and not just the what if. Partner can help you execute this. So here's some actionable questions, but these are things you can start today to ask your clients. Here's some great resources for you all if you are worried about the financial rating. A great chart, as you can see, Chubb does have great claim satisfaction. They also have very high financial strength. This is the study average. Notice all the carriers that fall below that. We do see these a lot uploaded into Holistiplan. So again, something to look into. Again, these markets are great for a majority of clients, but for your high net worth clients or particular clients, maybe considering insurance companies that have higher claim satisfaction makes sense. So some key takeaways, again, understanding exclusions, educate, serve as the calm. And at the end of the day, if it's not covered by insurance, they could be coming to you to use their assets under management. And then lastly, for the last 30 seconds, Holistiplan is really your insurance visibility. We help you spot risk and educate clients to better prepare. So we do this through reviewing current coverages. We point out missing or inadequate coverage, as well as we flag risky gaps that could lead to surprising claims. We also help better planning and proactive decisions, prepare clients for high deductibles. We point this out in our reviews. You can discuss the value versus carrying full coverage. Again, assess if those bells and whistles that we point out within our document are really necessary. And then ensuring that adequate protection, making sure their liability limits align with their net worth that they at time of a crisis. So we'll leave this last pull up for everyone, but really thank you all. I appreciate you. So again, would love to hear if anyone's ever had clients that have been affected or their retirement affected by a claim. Great. And if anybody wants to stay on, I have a few minutes to answer questions, but otherwise we can follow up with an email, Tracy, if that's the best way to go.
Okay, well, thank you so much, Megan. This was great, despite the technical difficulties. Thank you, everyone, for being so patient. And just a recap, we will send out the slides and the recording, so I'm sure you keep an eye out for that. And regarding questions that we didn't get to today, we will have them included in the recap email, so no worries, those will get answered for you. And thank you, everybody, for attending. With that, we'll see you next time. Thank you.
Bye.
Bye.